So I've spoken to a lot of traders through my one-on-one sessions, my coaching calls, and something that a lot of new traders struggle with, I know because this is what they're telling me, excuse me, is that they often can't hold their winners to fruition. They don't see their winners through, and they're often holding their losers too long. They're hoping that that losing trade turns around. Now, we have all been there. You know what I mean? I think if you say you haven't been there, then you're brand new to trading and today's your first day, or you're lying to yourself. And I think that anyone can overcome that psychological hurdle if you're aware of why it's happening. So in this little clip, in this argument here, I want to share the information with you guys that's helped me overcome this behavioral finance hurdle. It's based in this thing called the disposition effect. But the disposition effect can be broken down into two smaller theories. One is called prospect theory, and the other one is a mental accounting theory. So if we understand these two underlying theses, whatever you call it, beneath the disposition effect, then we can be aware of what our literal biology wants us to do, and we can then act differently. That's the goal. A lot of what I talk about, and I feel like I say it all the time, but it's just so true, is that awareness is the first step towards growth. Accountability is a piece of that, but without awareness, we don't even know what needs to change. So becoming aware of this disposition effect can allow you to change, can allow you to hold your winners longer and to get out of your losers quicker, because you know your biology is going to want you to do the opposite. And I've heard people say this many times, that in trading, sometimes just doing the opposite of what your gut wants you to do in that moment is actually the right thing to do. That's not 100% true, but for this conversation today, it kind of is, if that makes sense, because like I said, our underlying biology as human beings wants us to get out of winners quickly because we think that it's going to turn around and go negative on us, and we don't want to lose that money that we're up in unrealized profits. And at the same time, when we're losing money, we don't want to be wrong, so we don't want to take the loss. So we hope that it can turn around. If that's been you before, hit the thumbs up button or give me a yes in the chat, because I know it's been me. And like I said, understanding this disposition effect has helped me overcome that, and that's why I wanted to share it with you guys today. So let's talk about this prospect theory first. I'm going to put this article, the link to this article, in the chat for you guys and in the description of the video, so you guys can go watch it or read it if you'd like. But first, he talks about prospect theory before we get into the disposition effect. So follow me here. It says one of the central concepts in behavioral finance is prospect theory. Prospect theory argues that the classical model of decision-making, expected utility theory, is not a very good descriptor of the way decisions are actually being made by human beings. So prospect theory says the classical model of the way we decide things is not a good descriptor of it. The theory shows how people weigh gains and losses and probabilities and certainties in different ways. The result of relevance to investors is an explanation for why people get less positive utility from a gain of certain value than the negative utility of a loss of equivalent value. It also introduces the concept of reference dependency, whereby people always measure their financial position and other sensory positions from a reference point. So let's go into the mental accounting, and you'll see how this ties together. Mental accounting is an economic concept established by Richard Thaler, which contends that individuals classify different buckets of personal funds, of our money, differently and consider them non-fungible, and therefore are prone to irrational decision-making in their spending and investment behavior. The example of this is a person may have a low-yielding bank account in which he or she saves money for a vacation, while at the same time carrying credit card debt that's being rolled over every month at a high interest rate. The carryover to the stock market or to any trading market is that people tend to view each stock that they have purchased as a separate account, or each trade that they take as a separate account. And therefore, they consider the gain or loss on that stock separately, as opposed to evaluating the gains and losses across the entire portfolio and across your entire trading history. So now to put the prospect theory and the mental accounting theory together, we get the disposition effect. So the combination, like I said, of these two theories leads us to this disposition effect, he says, because a loss is felt more intensely than a gain. We can all agree with that. People tend to be reluctant to sell stocks at a loss. They don't want to be wrong. Instead, they are hoping, that word hope is the killer, that things will turn around, right? Similarly, they tend to sell stocks at a profit earlier than they rationally should. Even for the people that do backtesting and do chart markups and study a system and have rules, they still get out of trades too early sometimes. So the disposition effect is thus related to the concept of reference price, which says what is important to the decision to sell a stock is not the fair value, but the reference point of the owner. The reference price shows up in other applications of prospect theory, but for stock or Forex prices, it is the price at which the investor has purchased that stock, bought that currency pair, taken that trade. The decision to sell or keep the trade is thus informed not by the perceived the fair value of the stock relative to its price, but rather by proper gains and losses relative to the reference price. So what he's saying there is, let's say you were to take a trade, the trade goes up $10 or $100. It doesn't really matter the amount of money it goes up. What he's saying is you're going to reference just that single trade and how much money you've made on that trade more than you're going to reference it as a piece of your entire portfolio, a gain on the entire portfolio. So it's kind of talking about that short-term gratification that we all know we get sucked into. So this disposition effect is this bias, this human issue, you could call it, where we cut our winners before they are through, before we see them through, or before the market gives us a reason to get out, and we hold our losers hoping they end up turning around. So now, how do we overcome this? Well, for me, number one, like I said, it's awareness. It's understanding that this is something our biology wants us to feel. So then it's number two, it's when you do feel that, when you're in a winning trade and you feel that, okay, I kind of want to get out of this right now. It's not at my take profit, but it could turn around. When you say that, but it could turn around and go negative on me, the next thing you need to do is be aware of that thought and default back to your trading plan. And I know that a lot of people don't have detailed trading plans, so it's hard to say that. But for the guys like Nick Pippin, who was the one that said we should start reading this first, Nick has a very detailed trading plan. He and I have worked on it together for him. When you have a plan, the plan is what you should be acting on rather than the emotions that you're feeling in the moment. So in the moment, let's say you just started trading 10 standards and you're feeling like a big shot because you were only trading 5 standards a couple of weeks ago or whatever. Maybe it's just a standard and you were trading 0.5 lots, whatever. You up your size. As you up your size, if you're looking at your P&L as you trade, you're going to see more money in gains and more money in losses than you've seen before. And that money can distract you and make you say, oh, I'm up $1,000, get out of the trade. I'm up $10,000, get out of the trade. But what if the profit on that trade potential was $5,000? Why would you get out at just $1,000? That doesn't make sense. That's not proper trading. That's shifting you from treating this like a business to treating this like a casino because you're just happy to be making a little bit of money and you want to bag it. You've got to be able to see trades through according to your trading plan. And in the trading plan, you should have trade management rules. And then on the losses side, anytime you feel hope, if you can just be aware of that hope as an emotion, you can act differently. You can't remove the hoping. You can't remove the, I want this trade to turn around. That's going to continue to happen. But you can say to yourself, it's not working, so let me take half the size off if that's what your trading plan says to do. When XYZ happens, take half the trade. You can still hope that it's going to turn around, but it doesn't mean that's how you should act. Your actions have to be different from the emotions that you're feeling. How do we make that happen? Awareness. More conversations like this, more mindfulness practice by you, right? Through chart markups, through meditation, through self-development, self-growth. That awareness allows us to feel these feelings, but not let them drive the decisions that we make. So this disposition effect is just explaining the biological feelings that are like literally ingrained in our DNA that we're going to feel as we trade. So how do we act different? How do we act different? We just become aware. So we don't act in accordance with that emotion. Make sense? Everybody with me? Any questions?